Welcome to Elite Finance Insights, your gateway to the financial secrets of the world's most iconic success stories. Every tip we share is a key to the strategies once reserved for the elite, ready to unlock your financial potential. Let's dive in. It's Wednesday again. You know what that means. Today, as always, we have our special weekly update where we break down 3 crucial economic events shaping the US market. We'll reveal the most impactful news of the day and explain how these developments might influence your investments, whether it's in crypto, ETFs, or other market sectors. So, stay tuned as we dive into today's market-moving insights. In this video, we're going to break down 3 major economic events that are making headlines and are set to impact markets across the board. From the Federal Reserve's latest signals on interest rates to groundbreaking legislative moves in Congress, and even a significant update in the crypto regulatory space, we've got a lot to cover. So let's jump right into our first headline of the day. Our first major headline comes from Washington, where the Federal Reserve has recently hinted at the possibility of an upcoming interest rate hike. Over the past few weeks, inflation has been stubbornly high, and Fed officials are under increasing pressure to curb rising prices. In a series of statements during their latest policy meeting, several key figures suggested that the economic data, particularly the persistent consumer price increases, might force their hand sooner rather than later. In the short term, markets are likely to react with a bit of volatility, as investors generally have a love-hate relationship with rate hikes. On one hand, higher interest rates can mean better yields on savings and fixed-income investments. On the other hand, they can lead to a slowdown in consumer spending and borrowing. Stocks, particularly in the tech and growth sectors, might see some selling pressure as investors anticipate higher borrowing costs and slower earnings growth. Bonds, which have been sensitive to these policy cues, may experience further fluctuations as yields adjust to the possibility of a higher rate environment. Looking further ahead, a rate hike is typically a tool used to cool down an overheating economy. If the Fed proceeds with a hike, it could stabilize inflation over the long term, which might restore investor confidence in a sustainable economic cycle. For sectors such as financial services, higher rates can translate to increased margins on loans. Conversely, companies that rely heavily on debt financing might face higher costs, potentially squeezing profits over time. This creates a mixed bag for investors as, while some sectors may benefit, others could struggle. For the crypto market, a rise in interest rates could drive risk-averse investors to traditional assets, potentially leading to short-term capital outflows from digital currencies. However, if inflation is tamed, we might see renewed interest in speculative assets once the economic outlook stabilizes. While the Fed's indications about a rate hike can unsettle the market in the short term, the ultimate goal is to restore economic stability. Now let's shift our focus from monetary policy to fiscal policy, as our second major news item comes straight from Capitol Hill. In a bold move that's been making waves across both the political and financial sectors, U.S. Congress has just passed a comprehensive infrastructure bill. This landmark piece of legislation is designed to inject billions of dollars into various sectors, from transportation and energy to digital infrastructure and environmental projects. The goal is to revitalize America's aging infrastructure while creating new jobs and stimulating economic growth across multiple regions. Immediately following the bill's passage, we're likely to see an uptick in market optimism, especially among sectors that are set to benefit directly. Construction companies, engineering firms, and related service providers might see a surge in orders as government contracts roll out. The news can also drive positive sentiment in the broader market, lifting ETFs and mutual funds that have significant holdings in these sectors. However, there might be short-term disruptions as investors adjust to the expected government spending, and debates over the bill's long-term fiscal impact could introduce some caution in the bond markets. Over the long haul, the infrastructure bill is expected to have a transformative effect on the U.S. economy. Modernized infrastructure could lead to improved productivity and lower operating costs for businesses, thereby boosting corporate earnings. This in turn might support higher stock valuations across various industries. Additionally, by creating jobs and stimulating local economies, the bill could foster an environment of robust consumer spending. For the crypto market, this move might be somewhat indirect. However, a stronger economy usually translates to higher discretionary spending, which could fuel investments in emerging technologies, including blockchain-based solutions. Investors with long-term horizons should keep an eye on sectors that are directly tied to government spending, as they could represent significant opportunities in the post-infrastructure era. With the Fed signaling a potential shift in monetary policy and Congress setting the stage for economic rejuvenation, it is clear that we're in a period of significant change. Now let's turn our attention to a headline that is especially relevant to our tech-savvy and crypto-focused viewers. Our third and final major story today involves a significant development from the Securities and Exchange Commission. In an effort to bring more clarity and stability to the digital asset space, the SEC has introduced a new regulatory framework for cryptocurrencies. This framework is designed to better define the legal boundaries for crypto assets, establish clearer guidelines for market participants, and ultimately protect investors while fostering innovation within the burgeoning digital economy. In the short term, the crypto market may experience heightened volatility as investors digest the implications of the new rules. For some, the news might trigger uncertainty, leading to a temporary pullback in digital asset prices. However, others might see this regulatory clarity as a positive development, a sign that the government is working to create a safer and more predictable environment for digital investments. This dual reaction could result in rapid price swings and increased trading volume as market participants reposition their portfolios in anticipation of future developments. Looking ahead, the SEC move is largely expected to be beneficial for the crypto market. With clearer rules in place, institutional investors might gain the confidence they need to enter the space, potentially bringing more capital and stability. In the long run, this regulatory framework could help mitigate some of the risks associated with fraudulent schemes and market manipulation, paving the way for a more mature and sustainable market environment. Moreover, clearer guidelines can spur innovation as startups and established companies alike can operate with a better understanding of legal requirements. For ETFs and other investment vehicles, the enhanced legitimacy of the crypto market could lead to the development of new products that allow investors to gain exposure to digital assets in a regulated manner. Let's take a step back and consider the bigger picture. Today's headlines underscore a dynamic and evolving economic landscape, one where both government policy and market forces are in constant interplay. The potential Fed rate hike reminds us of the delicate balance central banks must maintain in controlling inflation while supporting economic growth. At the same time, Congress's ambitious infrastructure bill points to a future where strategic government spending can lay the groundwork for long-term prosperity, creating new opportunities across multiple sectors. And finally, the SEC's decisive steps in the crypto space signal a maturing market that is increasingly becoming an integral part of our financial ecosystem. For investors, these developments highlight the importance of staying agile and informed. In the short term, you may need to brace for some volatility as markets react to shifting policies and regulatory changes. However, with a clear understanding of these events, you can better position your portfolio to take advantage of emerging opportunities. For example, a cautious approach to growth stocks might be wise if a rate hike materializes, while exposure to sectors like construction and engineering could benefit from the infrastructure push. Similarly, for those with an appetite for digital innovation, the new regulatory clarity in the crypto space may signal the right time to explore new investment avenues or diversify into emerging technologies. As we wrap up today's update, it is clear that we're living in a time of rapid change and transformation. Whether you are tracking the Federal Reserve's next move, watching how the infrastructure bill unfolds in the market, or keeping a close eye on the evolving regulatory environment for cryptocurrencies, the key is to remain informed and ready to adjust your investment strategies accordingly. Thank you for tuning in to this week's Elite Finance Insights Update. We hope that breaking down these three pivotal news stories has given you a clearer picture of the forces shaping the U.S. market today. Remember, staying informed is your best tool in navigating the ever-changing financial landscape. Whether you are investing in traditional assets like stocks and ETFs or exploring the exciting world of cryptocurrencies, being proactive and well-informed can make all the difference. If you found today's update helpful, please give this video a thumbs up and subscribe to our channel for more weekly insights. Don't forget to hit the notification bell so you never miss an update on the latest economic trends and market-moving news. And if you have any questions or thoughts, feel free to leave a comment below. We'd love to hear from you. Until next Wednesday, keep your financial goals in focus, stay ahead of market trends, and continue unlocking your financial potential. Thanks for watching, and we'll see you in the next video.